this is Natalie with Claudia Tax. I wanted to follow up on the video about how your rentals are taxed and talk to you today about how passive losses are used and what we can do to be strategic with these losses, right? So this is just a passive loss video. So passive losses are what your rentals generate, okay? Rentals are passive income. That means they don't pay any payroll taxes, and that's great, but the downside is that if you have passive losses, there's a chance you might not be able to use them. So passive and active income, passive and ordinary, normally can't mix, right? They're like oil and vinegar. We can't mix them together. So what this means is we've got a few options. The IRS has what they call a small taxpayer exclusion. This says that if you earn under $100,000, right, your modified adjusted gross income, $100,000 or under, you can deduct up to $25,000 a year in passive losses. Once you get above $100,000, that starts going away, and once you hit 150, it's gone completely. So if you make 150 and above, you don't get to deduct any passive losses. They carry forward though. You don't ever lose them. So it's not like, oh, we had all these losses, but we made too much money. They're gone. That sucks. Nope, they roll forward to the next year. My favorite way to describe this, what it reminds me of, I guess, is if you ever played a certain game on Super Nintendo back in the day where you were a little Italian guy running around. If you already had the foxtail and then you got a mushroom that would turn you back into a full-sized guy, it just hovered in a little square at the top of your screen, right? You can't use both at the same time. And then when you needed it, right, you got bit by something, your foxtail went away, your mushroom dropped down and you could use it. Same thing with your losses. They kind of just hover there in the little box until you have a year with passive income, and then it drops down and you can use the loss. So your passive losses, like we said, if you earn above the 150 mark, unfortunately you can't take them. And this is actually kind of a weird number. It's not just your AGI, it's what they call a modified adjusted gross income. So I actually have a download on my website for you. You can visit colotax.com. I'll put a link below, and you'll be able to download this spreadsheet that'll tell you how much of your passive losses you can utilize based on your modified adjusted gross income. So check that out. But if you're under the 100 grand, you're good. You can use those passive losses each year. We talked about this in the last video. The reason you have losses on your rentals isn't because they're losing money. It's because of depreciation. You get to deduct that without a cash outflow. So ideal scenario, you have money in the bank at the end of the year, losses on paper, okay? So we're just trying to use those losses. So if you make over that 150 mark and you can't use the losses, what else can you do? Well, now we've got a couple options. One of my favorites is what I call loss banking, okay? So like we said, these losses don't go away. So every year they roll forward, and then in the year when you eventually dispose of that property, you sell that property, these losses become available. So let's walk through this. Let's say that you've had a rental. Let's say you have a bunch of rentals. You've got maybe 25 properties, okay? But you've never been able to use losses. Ugh, terrible. So we're gonna sell one, right? We're selling one of the properties. We've had it a long time. It's almost up on its depreciation timeline. We wanna get rid of it and get something bigger, something better. So in the year you sell it, you'll have a capital gain, right? Easy. The other thing to consider is that all of these back losses, let's say there's 5 grand a year and you've owned it for 20 years, all of those losses are now available to offset that capital gain. Great, right? Like you always hear people talk about 1031 exchange being kind of the holy grail of how you get rid of your real estate and not pay tax. Well, this is how you get rid of your real estate. Don't pay tax. Don't jump through hoops. Don't wait for timelines. Don't carry over your old basis. Like, this is the most easy, straightforward way to sell a property and not pay tax on it. So yep, it is a bummer and you don't have the direct benefit year to year of those losses, but be strategic about them. Don't just ignore them. Don't try to not maximize them because you can't use them each year. You need to know that when you sell it, you get all of those losses against the capital gain of the sale. That's huge. The other thing a lot of people don't realize is, so you get all of those prior built up losses against the property that sells, right? It can reduce that gain. You also get to use against your gain any losses from your other properties that occurred in that same year. So you can't use their old ones, they're passive ones, they're carryover losses. But if you've got 20 properties, we're selling this one, it's gonna have 100,000 gain, let's say, and it only has carryover losses of 80. Okay, that's still pretty good, right? We wiped out 80% of your gain. without doing a 1031, without jumping through hoops. So now we've got these other 19 properties. Let's say we knew we were selling that property in year 5. So in years 2, 3, and 4 on these other properties, maybe we put off some projects, right? Instead of doing some landscape improvements in 2, 3, and 4, or instead of replacing your appliances in years 2, 3, and 4, we wait till year 5 because we know in year 5 we're selling this other property. So in year 5, we have the gain from the property we sell. We have the losses from all the past years on that property. They wiped out 80 grand of it. And now on our other properties, we strategically planned to do work in this year, to do things that create extra expense in this specific year, because those losses we can use against this gain. So instead of each of those properties having their normal, say it's like a $2,000 deduction each year, we're bumping it up, right? We planned to put stuff off until this year. So now each property has a $5,000 deduction. $5,000 loss. We get to take all of that and also use it against the gain. So it is a huge bummer if you can't use your rental losses year to year, and I realize that, but keep in mind, work with someone who's strategic about it and you can use them down the road, okay? So that's the first way you get to use those losses if you are outside of the small taxpayer exclusion. Option 2 is what is called real estate professional status. This is a huge benefit. So this is an IRS status that basically makes it so that your passive losses have no limit. Let me say that again. Real estate professional is an IRS status that makes it to where your passive losses have no limitation. What this means is that you can earn $500,000, and if you're a real estate professional or if your spouse is a real estate professional, you can deduct $500,000 of losses if you have them. There's no cap. If you're married, only one of the 2 people need to qualify. So that's a huge benefit. What I see a lot is where one spouse keeps working their job that they love, if they're maybe the breadwinner, and the other spouse kind of steps back from their job to manage the properties, and they qualify for real estate professional, and then you have the benefit of both worlds. You still have the W-2 income, the high earning, and then you have an unlimited use of these rental losses against that earnings. So I'm not going to go too far into it. I've actually got a video coming out soon about real estate professional status. There's actually recently a tax case on it that I really like. It very clearly kind of shows you what not to do and when they tend to like disallow this. So I'll go into it more there, but the basics of this are you have to spend 750 hours a year on real estate. Super easy, right? That's only a handful of hours a week. But the one that catches more people up is you can't spend more time on any other combined activities than you do on that real estate. So what that means is that if you work a 9-to-5 job, probably not going to work. Historically, the tax courts disallow it. So those are kind of the 2 hiccups, right? Like I said, I'm going to go into this more in the other video. If you are curious about this, check out that video. We're going to go through this tax case. I'm going to point out what they did wrong, what the court said, this is why we're taking this away. And in this case, in that tax case, there was 55 grand of losses that they deducted. And the court said, nope, it made them pay it back. So we're going to cover that. We're going to go a little deeper into real estate professional status, what you need to do to claim it, how you protect yourself if it's audited. And like I said, we're going to look at the mistakes that these people at the tax case made and make sure you don't make those same mistakes. So check out that video. It's going to be the real estate professional tax case, and I look forward to seeing you there. Thanks, guys.